Hello, everyone. Thank you for joining us in the second edition of CPI's Portfolio Series. It's always a pleasure to showcase some of the scalable, investable climate finance vehicles that we've supported through our flagship capital mobilization programs, which are the Global Innovation Lab for Climate Finance and the Catalytic Climate Finance Facility, or CC Facility. For this session, we will focus on 4 vehicles supported by our programs that are operating in a sector critical to bolstering economic growth and climate resilience across Sub-Saharan Africa, sustainable agriculture, and land use. Before we dive into the presentations, though, it's important to take a step back and understand the scale of the challenge ahead of us. Limiting warming to 1.5 Celsius requires significant global investments, particularly from the private sector. And even if we believe a 1.5 scenario is temporarily out of reach, it's critical to note that the costs of inaction far exceed the level of climate finance required to achieve meaningful emissions reductions and bolster economic and environmental resilience. One of the things CPI is most known for is our analysis of global climate finance flows. We've tracked global public and private investments in climate action for over a decade on a comprehensive basis. And our latest report found that annual tracked climate finance surpassed USD 1.9 trillion in 2023. You can see in the green columns the average annual climate finance flows from 2018 to 2023, and the amount has nearly tripled since 2018. However, the yellow area on the graph shows the amount of climate finance that is needed annually by 2030 to avoid the worst impacts of climate change. And this amount is at least 5 times higher than the current level of climate finance flows. It's important to note, though, that despite the seemingly dramatic scale of this funding gap, it represents less than 5% of global GDP. Now, if we take a macro look at Africa's climate finance landscape, there are areas of promise, but also significant challenges. Funding has grown fast, from about $29 billion in 2020 to over $43 billion in 2022. But that still covers less than a quarter of what's needed to meet 2030 goals. To stay on track, flows need to increase more than 4 times each year. As I think we all know, agriculture plays a huge role as it makes up around 23% of the region's GDP, yet it continues to receive only a small share of total climate finance. And according to our latest data, the sector still needs about $7.8 billion more per year for mitigation and $5 billion for adaptation. These numbers make one thing clear. We need scalable and catalytic financial vehicles that can allocate capital towards impactful projects, thereby closing these investment gaps across a highly diverse set of markets. Despite the significant gap, key market barriers continue to limit the launch and scale up of high-impact investment solutions. And this is exactly the kind of gap that blended finance mechanisms aim to solve by using limited amounts of public or concessional capital to de-risk early stages and unlock private investment over time. And at CPI, we've tailored our programs to tackle these challenges through these initiatives. The Global Innovation Lab for Climate Finance, which has been operating for over a decade. The lab is an incubator that helps turn climate finance ideas into action by supporting the design and development of financial vehicles. Meanwhile, the CC facility, launched in 2023 in partnership with Convergence Blended Finance, supports vehicles at the later stage, focusing on those that have already been piloted and are ready to scale. Together, these programs unlock new opportunities for investors by managing risk and delivering impact at scale. In 11 years of operations, for example, the lab has developed a portfolio of 78 financial vehicles that have collectively mobilized more than $4.2 billion in investment. About 35% of this portfolio is exclusively focused on Sub-Saharan Africa, with another 5 partially targeting the region. And so far, the lab's Africa-focused instruments have secured over $540 million in new capital commitments across key sectors like energy access, land use, and affordable housing. Meanwhile, the CC facility has built a diversified Africa portfolio. Over 4 application cycles, we've received more than 900 proposals, selecting 10 vehicles in areas including sustainable agriculture, which is the focus of our session today. These grantees collectively across the region have secured more than 150 million in new capital, nearly 80% of which is from private investors, using approaches that range from de-risking agricultural loans through local banks to leveraging renewable energy credits to attract corporate capital into off-grid markets. Yet, demand continues to exceed available funding. This reinforces how urgent it is to expand blended finance solutions that can meet Africa's growing climate investment needs. With that in mind, I'm excited to turn the spotlight on our 4 vehicles supported by our programs, which will share how their solutions are driving climate impact, specifically in Sub-Saharan Africa's sustainable ag sector. The vehicles presenting today are the Catalyst Fund, Imata, Nordic Impact Fund, and the Tunza Fund. Before we begin with the presentations, let me quickly explain the structure of today's session. We'll hear 4 presentations in total. After those presentations, we'll have a moderated discussion that will dive further into specific challenges, opportunities, and insights relating to the sector. And then we'll leave some time at the end for questions from you, the audience. We welcome you to type your questions in the Q&A section throughout, which you can find at the bottom of the Zoom page. I'd now like to invite our first speaker, Melis Carraro, who will walk us through the Catalyst Fund, a $40 million venture capital fund investing in pre-seed climate adaptation startups in Africa. The fund targets 3 key areas: fintech for climate resilience, sustainable livelihoods, and climate-smart essential services. Welcome, Melis. Over to you.
Thank you, Joe. Hi, everyone. It's a pleasure to be here. I am Melis Carraro. I'm the managing partner and founder of the Catalyst Fund, and we are an early-stage venture capital fund and venture builder backing African startups who are building a climate-resilient future. Next slide, please. We started the fund with a simple mission. We invest in the entrepreneurs that are developing the technologies and business models that can help communities and businesses adapt to climate change and build resilient economies. Next slide. And to do that, it took a team of crazy and ambitious operators, investors, and ex-founders that see the enormous potential to scale the next generation of climate innovation in Africa, which we believe is uniquely positioned to be a leader in climate action at a global scale. And as investors and ex-founders, we've all supported over 100 ventures in our time via 2 prior Catalyst funds and via our own past experience. And we bring this to our approach to supporting ventures. Next slide. We decided to focus on one of the hardest, toughest part of this startup journey, the valley of death between the prototype and product market fit. And that's where most climate solutions stall, not because they lack potential, but because they lack this early stage capital and the right kind of deep operational support that can help them scale. Next slide. So in our model, we bridge this gap. We help ventures prove traction and then attract larger investments. We want to raise 40 million to back 40 companies and making basically 40 pre-seed investments of about 200,000 each, typically as the first institutional investor to back these companies. And for the strongest performers, we will then follow on at seed and Series A with more capital. But we also know that capital is only one side of the equation. So we embed deep operational venture building support and create connections with the largest community in Africa today of climate innovators and climate investors. Next slide. So we invest, as Joe said, across 3 complementary verticals. The largest vertical for us is sustainable livelihoods. So climate smart agriculture, food systems, land restorations, and the other focus on fintech for climate resilience. So think climate insurance, climate data tools to price climate risk, and climate smart essential services like energy, water, mobility, and healthcare. And we know that all sectors of the economy will need to adapt to climate change, but we focus on the most urgent challenges for the African continent. Next slide. So since launching the fund in early 2023, thanks to the lab support and now CCF, we've built a diversified portfolio of 24 startups across 9 markets and 10 adaptation subsectors. And the track record so far is strong. They've collectively reached 450,000 users, created more than 1,000 jobs, and mobilized over 23 million in follow-on capital, all under 2 years. Next slide. So an example of this is a portfolio company, Mazao Hub. It's an agri-tech company in Tanzania that connects smallholders to climate data, better buyers, and fair financing. And farmers with this can now plan, they can price, and they can sell more confidently, resulting in more stable incomes, but more importantly, in better resilience to climate shocks in the future. Next slide. And for them, we, with our model, with the deep value creation approach, we've worked for over 300 hours running product sprints, refining go-to-market strategy, supporting fundraising, sale, marketing, basically becoming the interim CTO, CMO, COO that early stage companies typically can't afford. And that's how our companies reach the next round faster and grow more sustainably. Next slide. So by 2030, our goal is simple. We want to make 20 million people at least more resilient to climate change, restore 10,000 hectares of land, create 3,000 jobs, and mobilize $1 billion more in follow-on capital for climate adaptation and resilience. So we invite you to partner with us, next slide, to co-invest, to share insights, and most importantly, help scale the next generation of ventures that are going to strengthen climate resilience across the continent. Thank you.
Thank you, Maëlys. And as you mentioned, Catalyst Fund has been supported through both the lab and the CC facility. And it's been a pleasure to see your fund scale and achieve success. We're excited for things ahead. Great. With that, we'll turn over to the Imata team. Please welcome Bram van der Bosch, who will walk us through that vehicle. Imata is a Kampala-based agri-fintech, raising 20 million through SPVs to deliver affordable loans and weather-based insurance for smallholder farmers in East Africa, with an initial focus on Uganda. Over to you, Bram.
Next slide, please. Agriculture is the backbone of economies in Africa. It accounts for a staggering 30% of the economy and is by far the largest sector. But there's one huge problem, and that is that banks do not lend to farmers. This $240 billion problem means that farmers are held back and cannot grow, but it really prevents Africa from growing into an agricultural powerhouse that we think and believe can and should feed the rest of the world. Next slide, please. Imata is changing this by providing loans to farmers. Sounds simple enough. Our secret, though, is that we distribute these loans through agricultural companies. And as a result, our loans kind of become like salary loans for farmers. Next slide, please. Banks still use a very old school distribution model in which they use bank branches to service farmers. This method is very expensive and inefficient and essentially means that smaller farmers, which make up the vast majority of the farmers, cannot access loans, and essentially it just doesn't work. In our model, we partner with agricultural companies to reach farmers. And agricultural companies can be dairy factories, coffee exporters, agricultural cooperatives, etc. Next slide, please. So we partner with agricultural companies to, first of all, reach farmers at scale, which is very important from a distribution perspective, but also to get validated data on these farmers that we can then use for our credit scoring algorithms. It also allows us to tap into an existing and already trusted agent network. And last but not least, and very important if you are a lending company, it gives us a source of repayment, and we get repaid at source when the agri companies pay their farmers. Next slide, please. The beauty of this model is that everybody wins. The agri companies with whom we partner, they increase their sourcing volumes by 80%. The farmers, on average, increase their productivity by 30%, and we achieve a default rate below 5%. As a matter of fact, our default rate since we started is 3.9%. Next slide, please. In our business model, we earn money on loans provided to farmers as well as to traders. We also provide software to digitize the agricultural companies, but we do that for free, because after all, who likes paying for software? We also provide crop insurance and digital payments to complement our products, but we do this without any markup since these products are expensive enough already in this part of the world. We launched in Uganda in 2021, where we're currently still lending off our balance sheet, and where we see sort of our activities as an R&D hub. We will launch in Tanzania in Q1 and in Rwanda in Q3 of next year, but there we will partner with banks. In Tanzania, we'll work with the largest coffee sourcing company in the world. And in Rwanda, we will work with Sukafina, which is the #1 coffee sourcer across Africa. Next slide, please. This doesn't look entirely correct, but that's okay. We have raised $1 million in 2023 in equity funding from Norsken, DRK, and other institutional investors. And we're currently open to raising a pre-Series A up to $1 million. We're also putting together a guarantee facility so that we can actually accelerate our scaling further. With this, we will grow our loan volume in Uganda to about $15 million, and we will hit our first $10 million in loan volume in Rwanda and Tanzania, which, very importantly, allows us to break even and become profitable. Next slide, please. Now, before disconnect and run and get your checkbook and wire some money to us, let's go back to the beginning. We believe that East Africa will become an agricultural powerhouse that will feed the rest of the world. We don't only believe this, we know this. It's time we stop looking at agriculture as some kind of subsistence activity, because we know that when we give loans, there is a section of farmers, about 10 to 50% of the farmers, that start growing very, very fast, season after season. And when they start growing, they will professionalize the industry and not just lift agriculture as a sector, but the whole of East Africa. So join us as we dare farmers to dream big.
Thank you, Bram, for that presentation, and excited to continue supporting Imata on your journey to scale across Uganda and the region. For our next financial vehicle, we'll welcome Olivia Byanyima to present Nordic Impact Funds, or NIF. NIF is an impact-focused fund manager with offices in Uganda and Denmark, and is raising a $50 million evergreen fund and a $5 million impact-linked financial and technical assistance facility to focus on East Africa, advancing climate resilience, gender inclusion, and livelihoods. Over to you, Olivia.
Thank you so much. Hi, everyone. My name is Olivia Byanyima. I'm a regional director and partner here at Nordic Impact Funds. So all of us in the room can agree that Africa has incredible entrepreneurial energy. What's missing is capital, especially scaling capital. At NIF, we exist to bridge that gap by channeling climate finance to African SMEs that are solving the real problems on the ground in agriculture and finance and climate resilience. Next slide, please. Next slide, please. Okay, thank you. We are a female-led evergreen fund investing in high potential SMEs all across East Africa. Our focus is very clear. It's where agriculture, finance, and climate intersect. Our real edge is in how close we stay to the work. We know these founders, we know their markets, and we know their customers, not from reports, but from being in the room with them when decisions get made. Next slide. Yes, but the system around us is broken. SMEs in our ecosystem face many structural barriers. Sorry, the last one. The first one is that climate finance, which we hear about globally, somehow never reaches African SMEs, at least not at the scale that it should. So for this, we raise and we channel climate finance into those hard to reach SMEs. Then the second thing is that the capital that does reach is just capital and can provide hands-on support. For this, we act as a growth partner, not just a financier. Then lastly, most funds in our ecosystem have short fund lives that force these premature exits. We are an evergreen fund that provides patient capital and exits when our founders are ready and when markets are ready. Next slide. So our solution is really to change the structure, not just the story. To the right, you will see a general comparison between us and a traditional closed-ended fund. Next slide. We back companies that make resilience profitable. So it has to be profitable. So from solar irrigation and soil sensors to agribusinesses that source from smallholder farmers to digital tools that give people access to finance and markets. That's where we see Africa's next generation of scalable businesses coming from. Next slide, please. In terms of our track record, it speaks for itself. In the few years we've been alive, we've made 9 investments. One of them is Muzahab that our friend before, Ms. Carrara, talked about with that Catalyst Fund. We've had 1 exit, and across the portfolio, we've had 120% growth among our companies. Every founder we've backed is African, and more than half of them are women. That's not by design. It's simply where we find the strongest operators. Around 60% of our portfolio is in agri-food systems, and the rest is in digital finance. It's exactly where growth and adaptation meet on this continent. Next slide, please. Beyond our returns, our portfolio companies have reached over 4 million people, and most of them are low income. So that's a big focus of ours. So our impact is local, it's tangible, and it's measurable. Next slide, please. Next slide, I want to talk about a few things that we've learned and that have shaped the way that we invest. One is that capital needs time. So our evergreen model gives it that. The next is that impact needs support. So our TIA facility provides the support. The next is that scaling impact needs incentives. So we have an impact-linked finance rewards, and that's what rewards the impact. And perhaps more importantly, we know that there can't be any climate justice if the people that are most affected, who are the smallholder farmers in the villages, the entrepreneurs that are building solutions for them on the ground, if those people can't access the capital to adapt, there won't be climate justice. So we see our role, however small it is, as correcting that imbalance. Next slide, please. Behind all of our work, we have a really experienced team, female-led team, based in Uganda. Sorry, I think I spoke too soon, but maybe we can move to the next slide. We have a highly experienced female-led team based in Uganda and Denmark. Our team has local expertise. We have very deep operational understanding of businesses in Africa, and we're hands-on partners every step of the way. Next, we're now welcoming new investors into our pool. Next slide, or maybe it's the last one. Our evergreen structure allows flexible entry at any time. All are welcome. So institutional investors, high net worth individuals, concessional funders, anyone bringing patient capital and good energy will fit right in. Thank you so much.
Thank you, Olivia, for the great presentation, and excited to dive in further in the Q&A section. And
Me too. Thank
finally,
you.
to wrap up this section of today's session and the presentations, we have the Tunza Fund, a vehicle with an innovative concessional debt facility combining microfinance, private debt, and technical assistance to address the underlying challenges to long-term, sustainable, and climate-resilient land management in and around African conservancies. My pleasure to invite Jonty Rollins. Over to you, Jonty.
Thank you, Joe. And hello, everyone. My name is Jonty Rollins. I'm the Executive Director for the Platcorp Group. Now I'm pleased to introduce the Tunza Fund as an innovative blended finance facility looking to unlock sustainable livelihoods and conservation in Kenya. The word Tunza is the Kiswahili word which means to nurture, and it reflects our mission to nurture people, nature, and capital together. Next slide. So the fund is driven by a seasoned cross-sector team combining finance, conservation, and community expertise. Platcorp is the leading initiative, and as East Africa's largest microfinance provider with over 20 years in sustainable finance. We have our on-the-ground team. We're joined today in the call by Dr. Peter Turrell from Sustain East Africa that have deep field experience across East Africa's conservancies and agricultural hotspots. And then finally, over 50 years of combined experience in investment management and conservation debt structuring with Conservation Capital and Conservation International as well. Next slide. So the challenge we're facing is that southern Kenya's rangelands are globally significant but rapidly degrading. Wildlife populations have declined by up to 80 to 90% since the 1970s. As a result of land fragmentation, fencing, and conversion to agriculture, with all of these accelerating, these have led to a lack of viable economic alternatives for these landowners. Where only 21 out of 111 conservancies are financially sustainable, the rest rely on inconsistent donor support. And without affordable long-term financing, conservancies can't become investable or durable. And this is where Tunza steps in. Next slide. So the Tunza Fund itself targets investment through growth capital to support both conservancy development and on-lending through microfinance loans to landowners. This concessional capital is accompanied by technical assistance, or TA, helping to reduce risk while expanding conservation areas. Capital allocations may include capital investments to strengthen existing conservancies, to support improved revenue generation capacity through ecotourism, livestock, or carbon and biodiversity schemes, or in the establishment of greenfield and new conservancies itself. The TA facility provides pipeline development and support services to enhance the growth and governance of local conservation enterprise, as well as nature finance expertise to establish linkages to international carbon and biodiversity markets. Next slide. So the fund itself presents progressive financing solutions where we combine a concessional blended finance stack that offers affordable finance to conservancies while also attracting and crowding in private sector investors. It's evergreen and revolving, a long-term vehicle that recycles repayments, aligning returns with conservation impact. We're impact first, in that the non-profit model of reinvesting all earnings guided by a science-backed impact framework. And lastly, catalytic partnerships, collaboration between private sector, NGOs, and technical advisory, combining finance, conservation, and community expertise. Next slide. On the impact side of things, to track impact progress, we track it across 9 key areas in a science-based framework that combines nature, economy, people, and the climate. Our headline results is that in the next 10 years, we believe we will protect over 100,000 hectares of biodiverse land. We will leverage capital at a minimum of 3 to 5x on the private side. We want to inject over $70 million economic benefits to rural communities and to sequester over 5 million tons of carbon in this time period. Importantly, we also apply key conservation covenants embedded in our financing to build nature-friendly practices on the ground and sustainable financing for agriculture. Governance advancement in gender equity in conservancy management and agricultural management, community buy-in and responsible tourism, and diversified, resilient livelihoods for landowners who live in and around these conservancies. Next slide. So lastly, in terms of funding opportunities, we're looking for catalytic, patient, and impact-oriented investors to capitalize the first loss and guarantee tranche of our fund. Together, that makes up a holistic fund of $10 to $50 million for our first close, the capital stack being designed in several ways. But in summary, the model is building off a successful debt portfolio from Conservation International, who invested $2.8 million in conservancies over the last 4 years in southern Kenya. We're now seeking to expand this. We already have $600K committed through the Black Foundation and Conservation International to date. And for the first loss guarantee, we're looking to raise 1 to 5 million, approximately 10% of the total amount, to de-risking private investors at a target leverage rate of 1 to 10, of up to 1 to 10. In terms of donor participation, this offers an opportunity for advisory committee engagement and high catalytic visibility as well. And the remaining 90% to be secured through a combined junior and senior debt tranche of between 9 to 45 million, targeting a 5.5 to 8% return, depending on your risk level that you're willing to absorb within this capital stack. So happy to answer any questions. Next slide, please, Joe. And thank you very much for the time. We're looking forward to chatting more.
Thank you, Jonty, for presenting such an innovative model. Great. Without further ado, we will move into the next section of today's session, which is the moderated Q&A. And we'll kick off with a few questions for our presenting teams. And specifically, I'd like to hear first from the Imata and Tunza Fund teams on this one. When we talk about Sub-Saharan Africa, we're obviously talking about a large and incredibly diverse set of countries. How do you both ensure that your investment approach is locally driven and responding to the specific contextual needs and opportunities in your target markets? Maybe Brahm and then Jonty.
Yeah, that's an excellent one. So we've done a couple of things. First one is just making sure we do our homeworks and we find out within agriculture, which of course is a massive segment, which pockets within agriculture work for us and we find interesting and are the better places to start. You don't want to start in the most difficult value chain within agriculture because, of course, you want to show the world that this works and build a track record that allows you to raise additional money. So value chains are not created equal. So for us, it's very important that we find the right ones and that we're very clear country by country which ones will work for us. Um, then on the other hand, yeah, we have been very intentional about growing first in East Africa and maybe not as some people do jump to the big markets immediately. There are companies out there that will just say, okay, I'm going to expand. So I'm going to go to Nigeria, South Africa, and Egypt because they're the biggest economies. Yeah, they may be, but they may not have an awful lot in common with the other market or your home market where you're active in. So that's why we said we're going to go for Tanzania and Rwanda. Tanzania, of course, has quite some size, but at least these countries are very similar to some extent in terms of climate, to some extent in terms of value chains, but definitely in terms of legislation, identity documents, and other things that we can piggyback on.
Yeah, I can jump in there on the same question. I think Bram summarized it well. But from a Trinza Fund perspective, this fund has been built from the ground up, which is the reality of how we think we have to do it when you're talking about land ownership and smallholders in Africa. We've designed and we've modeled the revenue streams from the ground up and then built that and designed that into a structure that can finance that efficiently, rather than the other way around when funds are often designed and now you go around looking for different problems to solve. And with that being said, we know that debt alone doesn't shift land use decisions. This is something that we've learned in many, many, many years at Platcorp, having over 20 years experience dealing with smallholders and small businesses across Africa. You have to provide a combination of support to build these markets and build these industries from the ground up. And that's how we build this on the ground reality with the Twinza Fund.
That's great. Thank you both. And a reminder to all attendees, please do feel free to submit your questions in the Q&A section, and we'll aim to cover some of those at the end. Maybe now turning to NIF and Catalyst Fund, wanted to get your thoughts because traditionally the perception has been that interventions focused on sustainable agriculture and building climate resilience are not well suited to commercial investment. But both your vehicles have already successfully secured commercial investment. So what are the characteristics of your approach and structure that you think have enabled you to be successful in securing this type of capital? Maybe I'll go to you first, Olivia.
Do you mean securing or deploying the capital?
I suppose both, but maybe let's focus on securing.
Securing, I'm here with my partner, Elizabeth. Elizabeth, would you like to talk about our path? There you go.
Our path to securing capital. It's been a long journey, I would say. It's been first starting with a pilot fund to show that we can actually do this, build our track record, get a showcase portfolio, do our first exit. And then when we had a portfolio with a very strong IRR, we said, okay, now is the time. Now is the time to raise that bigger fund. So we're now raising the 50 million euro fund. We had first closing of it early this year. And we are building it up gradually. It's an evergreen structure.
Thanks, Elizabeth. And I guess maybe just a quick follow-up before we turn it over to Maëlys. What's the reaction you've gotten from investors when you're saying that you're deploying, capital into sustainable agriculture? I suppose what is particularly appealing to them about your approach?
We found that agriculture is pretty much straightforward to investors, to the investors we talk to. I've never got the question why agriculture. I think all these wonderful fund founders, managers have talked about how key and how instrumental agriculture is viewed as instrumental in our economies. I think we've also been able to demonstrate that, especially when we come in first, as the first institutional capital in the door, that we've seen tremendous results. And those results kind of speak for themselves. Um, um, you know, it's when you come in with, even if it's a small check, but with a lot of conviction, one investor kind of leads to one another, and suddenly there's a few institutional investors on the cap table. We've been able to demonstrate that in the agriculture space. So I think track record also kind of speaks.
Thanks, Olivia. Over to you, Mylis. Would be great to hear your experience in terms of being able to secure that commercial investment into Catalyst Fund.
Thank you, Joe. It's a great question. I would echo a lot of what Elizabeth and Olivia also said. One is that we needed to design the structure so that we could allow private investors to come in at the senior tranche. So we're the blended finance structure in our fund with some protection, which gives comfort. And there are actually catalytic investors out there that have mobilization targets to attract private investment. So it was a win-win for everyone with this structure. But I will echo the fact that a lot of investors see investment in agriculture, climate smart agriculture, as a huge opportunity. You said it yourself, agriculture accounts for 25 to 30% of GDP in Africa, over 60% of labor force, like employment. That's a lot of where the youth and women are employed. So it's an impact mandate that many investors have, but also clearly a sector that's ripe for innovation. And if you think about it, a lot of African food is imported today, 50 billion in food annually, approximately. So the gap between potential and productivity and what it could be is large, and that means high headroom for innovation and for improvement. And that's exactly what our entrepreneurs are bringing to the table. We actually have one investor that has a mandate for us to invest 45% of capital, of investable capital, into agriculture with a wide definition. And that's what we want to meet as a target ourselves. Similarly, the companies speak for themselves. I think there's misunderstandings when we talk about agricultural innovation and what that really looks like. It's very diverse. So the opportunities are abundant across multiple, sub-technologies and innovations, from cold rooms, right? Cold chain innovation is critical, to precision farming with AI and data solutions, to soil sensors, so actually hard assets, or platforms that connect agricultures to off-takers. So we have to also think broadly about what the agriculture value chain needs, and then back the innovations that tackle the most critical pain points.
Thank you, Mylis. Those are some great points. And you mentioned impact. So I wanted to dive in on that a little bit further and hear from each of you because ultimately the goal here is we're mobilizing capital, but we're doing so to generate economic growth and resilience, and also climatic resilience. So how do you each think about measuring success from that perspective? What do you see as sort of the key ways in which you can achieve impact and capture that through your investment activities? And maybe I'll start with Jonty.
I'll speak quickly and hand this over to my partner, Peter Turrell. But I think for us, being a venture or a fund that's been built from the ground up, the idea is this doesn't work if it doesn't work for the people on the ground, and if we don't improve the situation for smallholder agriculture partners and livestock owners. These are our primary stakeholders, and developing a structure where we can securitize land and make it valuable for conserving it is ultimately the way to make their livelihoods better. But I'll let Pete speak to the specifics around what we're focusing on in terms of success for him.
Thanks, Jonty. And I think, as sort of Jonty pointed out in his presentation, we have a pretty comprehensive sort of impact framework. I think for us, we're a very much an impact first fund, trying to create some significant changes on the ground, both in terms of socioeconomic but also ecological outcomes. So a lot of what we've done from the onset is making sure we have a strong framework that aligns not only with what's needed on the ground, but is also cognizant of also what our funders from quite a diverse mix of funders. A lot of them are philanthropic and conservation oriented as well. So we've got a pretty strong framework, and we've already been engaged in collecting a significant amount of data to show the successes of these conservancies on the ground already, and providing technical support to these conservancies and other operators to make sure that the information is collected, and we can really tell that strong story, and that we're not having any perverse incentives or sort of unintended consequences of any action. So I think to us, it's kind of at the core of what we're doing, and we've already seen some fantastic outcomes both for people and for nature at the same time.
Perhaps I can add from our side. We are, of course, also an impact fund, and has been that from the very beginning. And we assess and measure impact throughout our investment process, from sourcing to exits. And it's actually, I think it's quite simple. What we look at is the depth of a solution. How big is the impact for one person that it's benefiting from the solution, and how many people can the company actually reach? How many are they reaching today, and how many can they potentially reach? And then the third one, how many of these people are within our target group? How many of them are low income? How many of them are women? And how many of them are smallholder farmers? So that kind of gives us a score that we use to assess the impact before we invest, and then we measure on exactly the depth, the breadth, and the inclusion later on. And then, of course, we look into additionality and contribution and all this. But it's actually fairly simple.
Thanks,
A key
Lisbeth.
differentiator for us, sorry, if you don't mind, is that we take it a step further. Yes, we measure, but when a company meets or exceeds these key impact milestones, like Lisbeth mentioned, increasing smallholder farmers or improving gender inclusion, whatever those milestones are, we then reward that performance through top-ups, concessional top-ups, or better terms, or reinvestment, right? So that's what we call our impact-linked finance piece.
Thanks, Olivia. Maybe over to you, Mylis.
Yeah, for us, we at the beginning struggled because climate adaptation and resilience was a very hard thing to measure. When we started, there were fewer taxonomies than there are today. Now there's actually a lot of folks that have dedicated time and effort to think through how you really measure improvement in resilience. So we have a dual approach. There's a quantitative approach where we measure lives more resilient to climate change, which is basically a reach number, like how many people we've reached, and then of that, how many women, how many smallholders, so similar to NIF. And we also measure other metrics that are core to our portfolio, so CO2 tons removed or avoided, liters of water conserved, hectares of land sustainably managed, and number of green jobs, and also tons of waste collected, because we have a more varied portfolio. So we needed to roll up the metrics that would tell the right story across the portfolio, from agriculture to waste management to water technologies. And those are metrics that the founders report to us on a quarterly basis. And we work, we then verify with them if the numbers make sense. But then to really look at what's happening at their customers' level, we partner with 60 Decibels, who has done several studies to really ask questions around how your true resilience has improved. And they developed a whole framework for this, which is really helpful, and I would recommend highly. And we also launched our own internal chatbot tool, which we started testing with portfolio companies, which is basically a WhatsApp-based questionnaire that can be sent to the customers of portfolio companies, obviously with data consent, and they answer them to give us the information that is more nuanced. Like, have you faced a climate shock? What has that resulted in? Have you lost income? Have you recovered from the income faster because of this solution? Do you feel like you're more resilient because you have access to this product and the market for yourself or your family? And those are, deeper qualitative questions that I think will add richness and color to our impact story. And the tech tools that exist today make it simpler. So we'll be able to tell you more once we've piloted it with more portfolio companies.
Thanks, Miles. And finally, over to you, Bram.
Yeah, on the climate side of things, agriculture is climate. The two are deeply, deeply interlinked. We responded to this in three ways. The first one is by tying loans to crop insurance. Guess everybody knows crop insurance, and it's a great way to stabilize the income of farmers. Of course, the challenge with crop insurance is always how do you sell crop insurance to farmers at a point in time where they don't have cash, because of course you sell crop insurance before the harvest when farmers tend not to have a lot of money. But because we are a lender, we can do that on a loan. So that one has been really, really popular, and thankfully we're able to do it at reduced rates nowadays. So it really becomes it's like going to the casino, but then you always win as opposed to always lose. Sadly, because climate is changing so badly, so that there are almost always payouts nowadays. The other thing that we do is investments in things that help farmers. So drought-resistant seeds is a massive area. So of course, many farmers just reuse the seeds from the previous harvest because they have no money to buy seeds. If we give them a loan, they can buy seeds. And if you buy improved seeds, some of these seeds are insane how good they can withstand the heat and how few days of rain they need to germinate. So that's one thing that we do. Obviously, irrigation is a big area. There are very cheap water pumps nowadays, which is awesome. The only problem with water pumps is they need a water source, and water sources are incredibly expensive. So for the somewhat larger farmers, what we actually see a lot happening is they rent bulldozers to sort of do damming so they can actually collect water on their own land. So that's one that we thought was quite nifty that some of our farmers are doing. And last but not least, there is the topic of timing. So back in the days, the seasons in this part of the world were kind of fixed. People knew when the rain season would come. So when the rain season comes, that's when you're going to plant. With climate change, that has shifted, meaning that farmers often get caught unaware when they are supposed to be planting. Now, if you need money to plant and suddenly you're planting 2 months before you thought, good luck finding that money. Good luck going to a bank hoping they will give you the money in a week before the window closes. And what we have done is we flipped the entire script around. So we'll continuously run the data on these farmers. And based on that, we pre-approve them for a certain loan limit. We communicate these loan limits to them well ahead of the season. And whenever they're ready, they know they can get their loan. And because we have already actually approved them, the only thing they need to do is say, yes, I want it, which allows us to disburse a loan, sometimes within 5 minutes, generally speaking, within the hour, but in almost 98% of the cases within the same day, meaning that whenever it's time to plant, even when it's off the usual cycle, they can get their money to invest in the planting season. So we're in the midst of this thing and have definitely found ways to help farmers cope with it.
Thanks, Bram. Yeah, really interesting and diverse and robust set of ways of sort of measuring success in the adaptation space. Okay, we're getting a lot of questions from the audience. Thank you for your participation. So we're going to turn over to some of those questions now and maybe do a little bit of a speed round since we have less than 10 minutes left. So I'll ask our presenters to please try to limit your responses to sort of 30 seconds to a minute. The first question is around sort of TA and what else do you provide beyond capital? I think we all know from our experience operating in the market, it's not enough to provide a check. You have to sort of go beyond that. So how do you think about value creation beyond just capital? And maybe we'll start with you, Maëlys.
Yeah, as I said, value creation and venture building has been part of our model since we evolved our funds since 2016. And really like the core basically of our value proposition. And in this fund, what changed is that we made it a key piece of the investment ticket. So it's not a sidecar TA. It's not something that is add-on, post-investment. Like as soon as we invest, there's this team of dedicated operators and experts that works for 300 to 400 hours, depending on the need, with founders for 6 months to a year, and meets the needs of the founders. So it's not, a program, it's not one size fits all, it's really bespoke. The founders tell us, look, I am a technological founder that needs marketing and sales experience, and I need help talking to investors. Okay, we'll dive into that, right? Conversely, if somebody needs help building out their data infrastructure, for instance, or improving product experiments muscles, then we have our product and data experts that can jump in and work hand in hand with the founders. And we found this model really helpful in driving results, aligning the objectives of the venture builders with those of the company, not the other way around, where you're trying to fit maybe a TA mandate, right? And really aligning incentives for everyone, because we know that every minute that the venture builders spend on portfolio companies contributes to growth, which means we contribute to returns on impact and returns on capital. And that's a proposition that has been quite appealing to LPs as well. And the founders, our net promoter score to date is 95 out of 100. So they may come for capital and always leave happier with the venture building support since the start, but it has to be localized, contextualized, and driven by people that understand the market context. That's for sure.
Thanks, Melis. Over to the NIF team. I think you may be on mute, Olivia.
I was saying I don't really want to repeat after Melis. We completely feel the same way. We're passionate about this TA support thing that we're calling our TA. It's a sidecar, yes, but it's embedded within the investment relationship. So we co-design based on the priorities of the founder, and we start the process during due diligence, right? Identifying those gaps. And then by the time we're investing, it's either part of a ticket, or if we have a sidecar, it's allocated funding to solve those exact gaps that we found.
Thanks, Olivia. Bram, over to you.
Yeah, probably more as a consumer of TA than a provider
Yeah.
of TA, to be very, very honest. But maybe that's also interesting. So I sometimes have to think back to those years, many years ago in university when we used to talk about the cost of doing business. And I never really got it. I grew up in the Netherlands, which is a pretty efficient and business-friendly country. But then when you start doing business in Africa, you suddenly realize what the cost of doing business means in terms of regulations, licenses, lack of talent, pretty high slash exorbitant taxes, no services provided by the government, et cetera, et cetera. To the point where I can totally understand many entrepreneurs, especially in the early years, they just can't convert that red tape and the cost of doing business into becoming a clean enterprise that fulfills all the requirements that essentially the business environment wants you to fulfill, because it's just way too expensive. Now, of course, when you don't do that and you get investors coming on board, you can't show them the documents that obviously investors are asking for, right? Have you paid your taxes? Have you paid the pensions? Are your people insured? Do you have all the licenses? Because obviously you can't be illegal. And that's somehow, as a consumer of TA, how I justify accepting TA. Is that subsidy that is unfair, or is it just sort of trying to counterweight the incredible cost of doing business in markets that are already challenging from a unit economic perspective and a scaling requirement perspective, versus much more mature markets like the US or Europe, where at least, the environment around you is lean, efficient, and is there to support you, as opposed to, as it sometimes can feel, be quite hostile and be another threat to your survival as a young company.
Thanks, Bram. And over to you, John T.
Thanks. I think I echo, or we both echo exactly what everyone said. TA is central to our offer, and as both a consumer and provider of TA, we know there's a huge variation in how this is provided. A lot of it can be very donor-driven or investor-driven, which can often conflict with the requirements of a company. But from our perspective, TA is something we build in through the covenants in our investments. This is where we think we've really got a unique value add, where the covenants help our investees to change their activities towards a standardized but also highly tailored blueprint towards becoming financially self-sufficient as a conservation enterprise or as an agricultural enterprise. And I think attaching TA to that means you're not only helping companies move in the right direction from a technical standpoint, but you're also kind of attaching this as a results-based outcome to your financing. So those two together, I think, is really what makes it work, actually.
Thanks, John T. Okay, we have 2 minutes left, so very quick speed round with one final question, and I'm going to consolidate some of the excellent questions that we've received. So in all of your experiences, what is one key factor that you feel makes a successful investment in the agriculture or land use space? And John T, maybe I'll start with you.
The least time to think. Yeah, I think when it comes to agriculture, ultimately understanding the clients or the investees' unit economics on the ground, it sounds simple, but it's incredibly critical to understand how you can invest or can't invest. And Bram spoke about it earlier, the contextual clarity you need in Africa, even from two locations that might be 20 kilometers apart, might be completely different in terms of the unit economics, and understanding that and why the socio-cultural barriers may or may not make something work is the be all and end all of lending, particularly in the smallholder space.
Great. Bram, over to you.
Yeah, so we get investments, but in a way, we also invest in farmers ourselves through our loans. Yeah, and for us, there the Northern Star is always what is the income of the farmer before they got a loan and after the loan. And yeah, that's where we see a lot of magic happening, as I briefly mentioned during the presentation. On average, that's 30%, but what we really see happening is there's a huge difference in the actual income in productivity and an income between the farmers. And there's some farmers that double or even triple the income in 2 years. And that's really for us where the exciting thing is, because that means they are growing, and that means ultimately they're the ones consolidating all the unproductive farms, because Africa, whether we like it or not, has hundreds of millions of farmers run by people that shouldn't be farmers. It's totally understandable why they are farmers, right? There's nothing else, but they are horrible from a productivity perspective or from a return perspective. It is just that nobody ever has tried to, for lack of a better word, have capitalism do its thing with agriculture, where slowly but surely the best farmers get bigger and the other people get another job because there is more money created in the economy. So that's why, yeah, we're always super, super happy when we see farmers really increasing their income, coming back to us for a bigger loan, making the farm ever bigger, because then we know what is really happening, which is, right, the best farms are consolidating the industry, which, if you ask me, has been one of the biggest Achilles heels of the past 50 years and why agriculture is so unproductive. And we shouldn't forget, this is what has happened and is happening all across the world, right? Anywhere else, this is happening. Latin, Asia, Europe, the US. We have increasingly seen bigger farms. Now that can be done in a good way and a bad way, but that's a different discussion. But the fact that the better farmers are accumulating more land and the people who are not so good at farming find different jobs, I think is a really positive thing on its own right.
Thanks, Bram. Okay, very quickly, over to you, NIF team. Olivia, you're on mute.
Was the question, what makes a really good agri investment?
Yes. In 30 seconds.
I think it would be something that is meeting an unmet need, unmet demand, positive, kind of good, or at least scaling unit economics that are not a company that has good unit economics is, one that if you scale, you don't destroy value. The resilience thing. So it helps, smallholder farmers adapt. Adaptation is a big thing in this space. And can replicate, so scalable.
And maybe adding also affordability, that if most smallholder farmers cannot afford, for example, irrigation, they cannot afford many of these sort of very resilience-giving solutions. So the real, because often it's not really rocket science what is needed, but the real innovation is often around affordability. And that's also where the financial solutions come into play, where you do pay-as-you-go, subscription models, all this.
Thanks, Elizabeth. And maybe over to you, Mylis, for the final word.
It sounded like there were two different questions. So
Yeah.
what makes a good agriculture investment for us is certainly one where we are seeing a clear path to impact, which means a model where the farmer is benefiting because the solution is affordable and is reaching them in a way that they can actually tangibly, access and benefit. Like oftentimes you have solutions to the market that, for example, underestimate the need for a touch model and just want to go with digital technology. But in reality, you're operating in communities that, yes, of course, smartphones are increasing in penetration, but you still need the human touch. And so how do you make that economically viable is key. And of course, models that can, in spite of this or with this, frankly, scale. And this blend of leveraging technology smartly, but making sure that you're designing with the farmer front and center, right, of your solution are those that are most successful in our portfolio. And I would also say you have to, again, think of the diversity models. There's various models in agriculture. All of them are not equal. So you need to be careful not to judge by past history or, pattern recognition, but really reevaluate who are the players here that need to be at the table, who are the distributors that need to be involved, who are the financiers that are best fit for the solution, right? It could be debt capital, working capital, equity, a blend of all, grants, right? And there's a specific timeline to that. And yeah, again, what's the critical value to the end client? The payer is really instrumental given the range. And then to your question, what's really needed in this space, I would say smarter capital that understands the agriculture economics, and certainly more patient and debt capital for models to really scale in the timeline that they need. And I would say venture is a fit only for a certain type of models. So let's get more diverse and faster capital to the space. And that will be my call to action.
Thank you, Mylis. And I think that nicely encapsulates the theme of today, given we've seen sort of a diverse array of different instruments being deployed in different approaches across various elements of the sustainable agriculture and land use sector. So wanted to thank, firstly, our presenting teams for their participation, and also the audience. Thank you all for joining and for your active participation. I apologize that we weren't able to get to all of your questions, but I will say this is intended to start a conversation. So we will be following up with a survey by email that will give you the opportunity as well to indicate which of the teams you'd like to connect with. And we'd really encourage you to pose your questions to them and to continue having these conversations so we can all work together to scale investment in this space. There will also be an email with a link to today's recording and slides as well. So that's it for today's edition of the Portfolio Series. Please do make sure to follow the lab and the CC facility. Subscribe to our newsletter for updates on our work in mobilizing capital for climate vehicles, and on future events like this one. So thank you, everyone, again, and we look forward to seeing you next time.
Thanks, everyone.
Thanks, everyone.
Thank you.
Thanks.